Today you're going to hear how to calculate exactly how much you need for retirement. And not just that, I'll also be showing you a method whereby if you break your retirement time frame into 5-year blocks, you can actually calculate how much you might need for each 5-year time frame. Everything will be very neat from there. So if this helps you in your retirement planning, continue watching on. Hi guys, welcome back. Without further ado, let me share with you this method which is called time-based retirement buckets strategy. The first step to adopting this approach is to break down your retirement years ahead in 5-year blocks like what I've mentioned in the intro of this whole tutorial. So take for example, you're age 55 and you imagine your lifespan to be until the age of 80. So let's break them out into 5-year time frames. Now to 5 years later, 5 to 10 years later, 10 to 15, 15 to 20, and lastly 20 to 25. Of course, if you live past the age of 80, quite possibly what's left is your government pension, CBF. But as always in life, we can't control everything. We just have to make accurate assumptions and do the best we can to forecast what we might need. Then the second step is to label each of these buckets into cash, which is for the 0 to 5 year time frame, defensive allocation to the 5 to 10 year time frame, because 5 to 10 years in the investment world is not a very long time actually. This will be bucket 2, and subsequently for buckets 3, 4 and 5, we can call them equity allocation buckets. Then the second step is to add in fixed expenses, discretionary expenses and other expenses into the projections of what you might need these buckets to fulfill. Now when you think about these expenses, you should factor in certain level of assumptions on inflation, medical expense inflation also, because when you get older, there's definitely more costs going towards medical, correct? And also prepare something maybe for yourself that is fun, like a holiday expense, especially in your early retirement years. Quite obviously, the holiday portion belongs to the discretionary spending, and what falls into other expenses could typically be, kids getting married, you might want to prepare some. You might need to think about renovation, because 10 years later, your home might become very old, and you do feel you might need one last renovation to last you to the end of days. So again, these 3 columns are fixed expenses, discretionary expenses, and other expenses. So with that, let me show you a possible template, and this is what I have prepared. Say for example, you're age of 55 and you check your current expenses are about 2,500 a month and you like to input them as fixed expenses. They should again include transport costs, insurance costs, food and housing needs. These fixed expenses, as you can see colored in green, inflates over time because these expenses definitely go up, correct? You cannot live without them. You definitely need transport in some way, you definitely need food in some way, even though as you grow older, you don't mind cooking more at home and not going out to eat that much. Then the second part is discretionary expenses. And in this example, I like to think that if someone retires at the age of 55, there could possibly be 10 good years of traveling. That's why discretionary expense is larger for the first 2 5-year blocks. Subsequently, discretionary expense drops because not too much strength to travel, correct? But if you're fighting fit, you want a lot of traveling years, then go ahead and increase this number. Last but not least, other expenses. Quite possibly something you throw in is, for example, you need a car. In the next 5 years, because your current car is quite old already, you do expect yourself to need the car, you like the convenience, you are willing to pay for it. And quite possibly you see yourself owning a car for another 10 more years at least before your children become big and maybe you can start using their car. In that case, from the age of 65, just in case you don't know, you need to go for eye test to renew your car license. So driving on the roads when you're old is actually not too common. Then how about this? Something prepared, 200,000 in 5 to 10 years time. Maybe your kid is going to get married or maybe your kid is going overseas for education. Let's put that into other expenses in the 5 to 10 year time frame. And last but not least, 100,000 renovation in a 10 to 15 year time frame, whereby quite likely this will be your last big renovation to last your final days. So with all these forecasts of expenses going in, let's make some projections as to what we might need if we have a sum of money today to allow ourselves to fulfill all these various expenses. For the cash bucket, let's put the assumption that it can derive 2.5%. In that case, CPF OA pays 2.5% already. Then for the defensive bucket, imagine this to have more bonds, whether it's short duration bonds or high yield bonds. This bucket should not be too volatile and hopefully can deliver you 4% per annum. Last but not least, for buckets 3, 4, 5, which is the equity allocation buckets, these should get 6% at least from the equity markets. And that's a belief that I also share because over time, equities do well. Yes, it might ride up and down, but if you see on Nasdaq's long-term track record, 6% from equity markets are definitely achievable. And with that explained, we can actually do a present value of all these various expenses if we are able to achieve this rate of return. And I actually done the heavy lifting for you. And before I share the numbers, let me firstly invite you to smash the like button, smash the subscribe, especially like topics like this that helps you in terms of understanding retirement planning. And the number goes like this. You would need 376,000 in this first cash bucket to fulfill your car other expenses as well as your 30,000 fixed and discretionary expenses. You will also next need 372,000 in this defensive allocation bucket that generates you 4% return to fulfill the various expenses highlighted above. Then subsequently for bucket 3, 4 and 5, whereby it's fully invested into equity markets and you have a long investment time frame, if you can compound at 6% rate return, the starting amounts you will need today is just 168,000 in bucket 3, 99,000 in bucket 4 and 81,000 in bucket 5. So all in all, the total budget needed is about $1.1 million. If coming to here, if for example you have only $1 million, you can do a 90% proration to all the figures above and work towards there. Or you could simply just fill the cash bucket first, fill the defensive allocation first, and maybe just sacrifice the last equity bucket, which is 20 to 25 years time, at the age of 76 to 80. That bucket may not be full, but again, we have a lot of time to adjust for things. When it comes to assumptions, it's always, we cannot expect the answer to be foolproof, and there's still going to be certain variance to the outcome. Now, there's certain benefits to following the mentioned time-based retirement bucket strategy, and I'd like to share with you what are my findings going through this whole entire exercise. I think the first clear thing is there are milestones that are visible. You know, it's like when we are in corporate world, we need to do forecasts for the team, for our company's projections and stuff. When we have a forecast, it's better than nothing at all. It's something we can work towards and keep a goal. So in this whole exercise, we can really prioritize what we might need, and we can really keep a long-term time frame. Because when we go into equity markets, we need to be sure, okay, for next 10 years, I've set up my expenses really. I don't need to worry, especially if equity markets come down. Because the whole idea is this. In the next 5 years, your cash will be drawn down from bucket 1. And when bucket 1 is drawn down, bucket 2, which is the defensive allocation bucket, will move towards bucket 1, whereby these investments are sold off to become cash. Subsequently, bucket 3 flows to bucket 2, bucket 4 flows to bucket 3, and bucket 5 flows to bucket 4. Then the next natural question is, then at the end of 5 years, what if equity markets are bad? Bucket 3 flows to bucket 2, that means I'm going to sell equities to buy more defensive positions, correct? Now again, there is still a long leeway, or there's a period of 5 years for each whole exercise. It doesn't mean by year 5, equity markets are bad, you die need to sell. You still have certain flexibility to wait out for a better period, and nothing is cast in stone. But as always, remember when you invest in equity markets, look long term, be ready to ride out market cycles. Because as I've shown in the previous tutorial also, for a 5-year period, there is a good chance that you can ride out even a bear equity cycle. And if you happen to be lucky along the way, whereby investments in the equity markets deliver more than 6%, then it's quite prudent to convert some early into the defensive positions, so on and so forth. Now coming to here, let me firstly throw out some questions that could be what you are thinking of. The first is that if I have 375,000 in CPF as excess over the full retirement sum, does that mean that my first bucket is already fulfilled? Because anyway, CPF always gives me 2.5%. I only need to worry about 372,000 in bucket 2 and buckets 3, 4 and 5. The quick answer is actually yes, and in that case, this also applies if you, for example, don't like CPF Life. You want to pledge your property for basic retirement sum, you want to keep your CPF OE there for you to draw as and when you need, then this whole equation still apply. Do know as always, you will need to withdraw from your CPF SA first when you are past the age of 55, and as always, the first 60,000 in your CPF attracts an extra 1% of interest. Then the second question is, if I have SRS, how does this add on to the retirement bucket equation that we have been discussing so far? Now, there are a few ways to look at it, and let me share with you a very simplistic approach to visualizing how SRS could be part of your retirement buckets. As you do know, SRS can be withdrawn from the age of your 63. But if you don't really need it, you can choose to withdraw, for example, from the age of 66 onwards. There is no hard and fast rule, but once you start withdrawing, there's a 10-year window. So for simplicity, let's assume SRS in your equation is meant to fulfill buckets 3 and 4. What that means also, if you have 267,000 already in SRS and you're willing to invest it fully in equities, that could eventually fulfill the buckets 3 and 4 that you would need in your retirement years. Then the only shortfall is bucket 5, whereby you invest 80,000 of cash and you can fulfill that expense gap you'll need eventually. And as always, if you have other questions, do leave in the comment sections. We can have a good discussion on how this bucket theory can work and other areas we can even improve on this whole approach. And same as my previous tutorial on retirement planning buckets, I'd like to propose again, could we use a simpler version, because the current method is cash, defensive allocation, and equity for buckets 3, 4, 5 and onwards, whereby there's investment time frame of more than 10 years. I've been thinking about it and I still like using balanced funds to round up all the assets, whereby a balanced fund gives you 60% in equities, for example, and 40% into bonds. Let me show you two examples of balanced fund. The first is actually dimensional world allocation 60-40, and there's actually a Sing dollar class for this fund already. Take note again, the Sing dollar class fund does not have that long a track record, but the strengths about this dimensional world allocation 60-40 is it's global and it's low cost. Then if you prefer something with a long-term track record, you can actually consider First Sentier Bridge Fund. This has been around since 2003, and this fund is focused on Asia's blue chips. So there are definitely balanced funds that can help you fulfill your investment objectives. And if you were to use this to lump up all the investments that we might need for the entire retirement duration, a way to conceptualize is to do this approach. 3 years of expenses in cash, whereby it's 2.5%, and then everything else in a 60-40 balanced fund. The good part about balanced fund is that when equity markets go up, they sell down the equities to buy bonds. And when equity markets go down, they actually sell the bonds to buy back equities. So naturally, you get that benefit of selling equities on the high and buying equities on the low. And it removes also the hassle of transferring equities from bucket 3 to defensive positions in bucket 2 when you mix everything into a balanced fund and use them to asset allocate for you. So if we were to use a 5% assumption on a balanced fund, whereby these two balanced funds mentioned above have delivered in terms of long-term return, they've actually done the calculation to show what possibly is needed. For 3 years expenses plus the car, which we've mentioned as a possible other expense, what is needed in this cash bucket is just $269,000. Then everything else to fulfill all those expenses, if the bucket can grow at 5% per annum, will be $858,000 only. This will cover all the other expenses, discretionary expenses, and fixed expenses of the various time frames that we mentioned above. And the only problem left is after the age of 80, which is 25 years time. Hopefully this whole planning exercise has food for thought for you. And as always, if you're looking for one-to-one fee-based retirement planning, look for my links below. And thank you for watching to the very end. With that, let me introduce you to the previous tutorial I have on risk-based approach to retirement planning buckets. If you have seen that already, let me suggest for you to check this tutorial out, whereby I've done a deep dive for this lady's stocks and structured products on margin. This was a fee-based approach that I've done with her, and this is a more in-depth case study that could be intriguing for you. With that, I'll see you over either of these tutorials, and I'll sign off from here. Take care as always, goodbye.